Welcome to the SNB Experts Learning Platform. In Module 1, we examined the architecture. Now, in Module 2, we move to action. We are discussing IFRS 1, first-time adoption of IFRS. This is how a company makes the tactical transition from local standards to the global language of finance. Let's begin the briefing. Our learning agenda is rigorous. We will define the first-time adopter, prepare the opening statement of financial position, and analyze both mandatory exceptions and optional exemptions. We will then master the required reconciliations and conclude with a comprehensive case study on green tech manufacturing. Every section is a critical maneuver in your transition strategy. Precision is required. So, who is a first-time adopter? It's an entity that presents its first financial statements with an explicit and unreserved statement of compliance with IFRS. If you previously reported under local GAAP or only prepared IFRS for internal use, you are in. But if you have prior publicly available unqualified statements, you are already committed. Know your status before you proceed. Qualification depends on your reporting history. Even dormant entities can qualify if they haven't prepared statements recently. But once you commit, you must track your key dates with absolute precision. The date of transition is the beginning of the earliest comparative period. For a 2024 reporting date, your transition date is January 1st, 2023. This is where your IFRS ledger begins. Secure the timeline to ensure compliance. Information integrity is paramount. Moving to Section 2, the opening IFRS statement of financial position. The general principle is full retrospective application. You must apply every standard effective at the end of your first reporting period as if you had always been an IFRS reporter. It is a total reset of your financial intelligence. Strategy requires a clean slate. This means you must recognize all assets and liabilities required by IFRS, de-recognize those not permitted, and reclassify items into the correct categories. Most importantly, all transition adjustments go directly to retained earnings or other equity, never through the profit or loss account at the date of transition. This allows users to see 2 years of clean IFRS numbers. You are building a comparative dossier that defends your financial reality. Accuracy is the ultimate goal. Section 3 deals with mandatory exceptions. These are prohibitions. Even if you want to apply IFRS retrospectively in these areas, you cannot. They are designed to prevent the use of hindsight to paint a better financial picture. In the world of intelligence, we rely on the facts as they were, not as we wish them to be. No hindsight allowed. There are 5 main prohibitions: estimates, derecognition, hedge accounting, non-controlling interests, and classification of financial assets. Take estimates. Your IFRS estimates at transition must be consistent with your previous GAAP estimates unless there is evidence of an error. Hedge accounting relationships also do not automatically transfer. They must meet IFRS 9 criteria at transition. You cannot use today's knowledge to correct yesterday's tactical decisions. Precision is in the original record. Section 4 provides optional exemptions. These are your elections. They offer practical relief from the high cost or complexity of full retrospective application. Think of them as tactical shortcuts provided to ensure a successful mission. You choose which ones to use based on your specific reporting needs. Strategy is about choosing your battles. Key exemptions include business combinations, pensions, and share-based payments. But the most widely used is deemed cost for property, plant, and equipment. You can use fair value at the date of transition as your new cost basis. For capital-intensive companies, this often leads to a significant increase in reported equity. It's a one-time starting point that reflects economic reality more accurately. Use this tool to secure your asset values. Accuracy starts with a solid base. For leases, IFRS 16 offers 2 approaches: full retrospective, or the more common modified retrospective approach. Once you've made your elections, you move to Section 5, required reconciliations. You must explain to your users how and why the numbers changed. In our world, transparency is the only way to maintain credibility. Secure the audit trail. You must provide 3 key reconciliations: equity at the date of transition, equity at the end of the last GAAP period, and a profit or loss reconciliation for that same period. You must also explain material adjustments to the cash flow statement. This illustrative structure shows how you bridge the gap, from PP&E uplifts to lease recognition. Every adjustment must be justified and disclosed. No hidden numbers. Transparency is your mission. Information success depends on it. Proceed. Section 6. The Green Tech Manufacturing Case Study. Theory is one thing, but execution in the field is where we prove our skill. Green Tech is a medium-sized manufacturer transitioning to IFRS in 2024. We've identified key differences in leases, financial instruments, and employee benefits. Let's analyze the tactical deployment of IFRS 1. Strategy meets reality here. Green Tech transition date was January 1, 2023. They identified that factory buildings were almost fully depreciated under local GAAP, despite having high actual values. They elected 4 key exemptions: business combinations, deemed cost for PP&E, the modified retrospective lease approach, and actuarial losses. The deemed cost uplift alone was $42 million. This is a massive shift in their financial position. Understand the starting point to predict the outcome. Precision is the mark of an error. Look at the Green Tech equity reconciliation. We start at $120 million under local GAAP. After adding the PP&E uplift and adjusting for deferred tax, leases, and credit losses, the IFRS equity at transition stands at $142.6 million. That's an 18.8% increase. In this mission, the transition actually strengthened the balance sheet. Strategy pays off. The largest driver was the PP&E uplift. But remember, while lease capitalization was neutral at transition, it will change profit or loss in future periods. The practical considerations are clear. Data availability is your biggest challenge. Use optional exemptions to reduce the burden, but never forget the deferred tax consequences. Every adjustment has a tax tail. Auditors will scrutinize your opening balance sheet heavily. It is the foundation for all future reporting. Secure the foundation. Mission integrity depends on it. So, the golden rules. Mandatory exceptions prohibit the use of hindsight. Optional exemptions provide relief from costly retrospective application. You must disclose the nature and effect of every election you make. This quick reference guide is your reporting compass. Use it to navigate the transition maze. Information success is in your hands. Briefing almost complete. To recap, IFRS 1 is about starting fresh with a single transition date. Adjustments go directly to equity, not through profit or loss. Avoid common errors like forgetting deferred tax or confusing the transition date with the reporting date. Challenge yourself with our review questions. Define the first-time adopter status and explain the deemed cost election. If you can answer these, you are ready for the field. Knowledge is your best weapon. Master the transition to master the market. Proceed to final review. Mission success is in sight. You have completed the Module 2 briefing. The road to first-time adoption is clear. Use these tactical tools to build more transparent and more accurate opening balance sheets. Remember, build it once, build it right. That is the mark of a true IFRS professional. Dismissed. Thank you for your service to financial clarity. I'll see you in Module 3. Prepare for share-based payments. Goodbye. For more professional financial modeling and investment analysis insights, subscribe to the SNB Experts YouTube channel. Thank you for following our Module 2 training. I invite you back for the next briefing. Until then, goodbye and stay focused on the architecture. Delivered on behalf of SNB Experts, success is in the details. Final debriefing complete. Transitioning to next mission. Goodbye.